Hoping to save some last minute tax? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And around this time of year, right at the end of the tax year, so that runs to the 5th of April each year, there is a good opportunity for a lot of people to save some last minute tax. Of course, you have all year to do this, but there's always a good time to remind people about what's possible. And particularly if you're listening to this now, you've probably got a few days left to make some decisions and have a look. Now, what I would say about this is, as always, these videos are designed for the small business owner. Now, we're talking about sole traders and self-employed people with a tax year ending the 5th of April in this video. But also, if you've got a limited company and your year end runs to the 31st of March, depending when this video comes out, there might be some last minute tips for you also. And I would say that don't switch off straight away if you're not in that bracket, because generally a lot of these tips, as I just said, are going to apply all year. So it's worth watching so that you can get ahead of the game into the new tax year. I'm sure we'll probably do a video reminding you about this stuff as the year goes on as well. Now, before I get into the video, if you do like these videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more just like this one. So where to start then? I think for me, the place to start is having a look at expenditure that you need to make in the next few months. So if you're thinking particularly around renewing your equipment, I mean, we've just done this. You look around, how much IT equipment do we need in the next few months to renew? Things like this. If you buy them now and bring those decisions forward, you're going to impact the next tax bill. You're still, if you were going to get tax relief anyway, you were still going to get tax relief if you bought them in 3 months' time, but obviously that's not going to affect your tax bill for some time. You're actually, the line's going to be drawn at the 5th of April or the 31st of March, most likely if you're a limited company with that financial year end, and if you can get your profits reduced or some special allowances in for that period, you're going to reduce that next tax bill. I'd never say to you, as you already know if you've been watching any of my videos, go and spend money just to save tax, because that's not a great idea. But if you need these things anyway, of course, thinking about when is the best time to buy them is a really good idea. And it is around this time. You know, if you're thinking of doing it, I don't know, May, June, I think the worst time is if you went and refreshed a load of equipment in April, and you could have done it, let's say late April, and you could have done it either in the first few days of April or, you know, a little bit before at the end of March. You would have then been able, as a sole trader, to make sure you've reduced your profits and reduce that tax bill. So think about the big stuff that you might be buying, the equipment or any other bits of expenditure you're doing. There are, as always with tax, some caveats around when you have to make use of these things. So, and also things like stock, people will often say, oh, I'll go buy a load of stock and that will mean that I won't have any tax to pay. And that can be true if you do your sole trade accounts on something known as the cash basis. But for a lot of people, and particularly limited companies, if you've got any unsold stock at the year end, that kind of gets set off to one side for later. It's probably the easiest way to explain it, and it won't actually help reduce your tax bill. But if you are a sole trader and you're preparing your tax return based on what you've actually spent in and out, what's known as the cash basis, that could help you. But outside of that, yeah, just think about, you know, if it's bits of equipment most of the time, if you're thinking of last minute changes, last minute things, if you can get that equipment into your hands and into use by the end of the tax year, it's going to be a good place to save some tax. Now, while we're talking about the more boring tax saving opportunities, now is a good time to review your records and make sure you've captured anything that you paid for personally. If you're a sole trader, self-employed person, and you've got a tax year, the normal tax year end on the 5th of April, now's a really good time to just check you've got everything together. Check your records. What have you paid for personally you might have forgot about? How many miles have you done personally in personal cars that you might need to get a mileage log together to make a mileage claim? All these kind of things are easily missed if you're a limited company. And even if your year end isn't 31st of March and around this tax year end, and actually it's a little bit later, sometimes because the mileage limits and other limits are linked to the personal tax year, it's worth thinking about just getting those records together now anyway, just so you can see where you're at. So start looking at those things, because the easiest way to save tax is to do the boring things like keeping good records. So just go and have a look, particularly if you've paid for things on personal credit cards or if you use cash, they might not be in your kind of main record capturer. So have a look at that one. Now let's talk big stuff. If you're selling the big stuff, so things like property, crypto, shares, it might not be physically big, but you know, these things that are slightly higher value items, what's known as making a capital gain. You're going to sell these big items. Your capital gains annual allowance, so that's a separate allowance that you get as an individual, has been slashed massively this year. So you used to get, if you think as an individual, most taxpayers will have £12,500-ish tax-free income they can earn each year. And there used to be a separate annual allowance, an annual exempt amount, that was £12,300 in the previous tax year. This year it's been slashed to only £6,000. So you can make £6,000 of profit of gain on something like selling a lot of shares or your residential property, not your own one, but say a buy-to-let or something like that, before you had to start paying capital gains tax. Next tax year, that's getting halved again to just a mere £3,000. So right now, if you were to sell a residential property, and depending on your other income, you might be £840 better off in tax selling it this side of the tax year, for example. I won't go too deep into the maths of that, but it is possible. But just think about those things. If you're thinking of selling a load in the early April, you're going to part with some shares or some crypto or something you've got, you might decide to split it into 2 transactions. You might do some now, use this £6,000 profit annual exempt amount against that gain, and then you have a reset on the 6th, the 5th, 6th of April, and then sell a load more, and you've got this new £3,000 allowance going into the next tax year. And it's worth just thinking about the timing of that. It all depends on your situation, your tax rates, of course, but have just a thought process about when's the best time to do that, taking into account those annual allowances. But that particular allowance is very much use it or lose it. So you want to make use of it if you're going to. Now I'm going to mention pensions now, and I think pensions is one of those things that people just switch off. I watch the video stats probably drop at this point, but please hang around for it because they're oddly more exciting than you might think from a tax point of view. Again, if we're talking about sole traders and the self-employed, you're normally going to make a personal tax contribution, and there's a personal limit to the amount you can contribute every year. Now this one isn't use it or lose it. There is possibilities to bring some of that forward, but you might still want to think about what limits they are, and they're quite high. I mean, it's 60,000 this year that you can contribute for most people, so that's quite a big amount of money, and you can bring previous years forward with you when you do make over that kind of contribution. But think about it anyway, because those limits are there, and again, it's particularly good if your profits are over, say, around £50,000 as a self-employed person. That can really help impact your tax bill on your tax return. Now, I don't like to talk too much about pensions here because it is regulated financial advice in the realms of financial advisors, not us mere accountants, but the tax side of it, of course, we can talk about, and you get a tax top up for most pensions in that pot when you make that contribution. And as I say, if you're going to be a higher rate taxpayer, there's some good impact on your tax bill, so consider that. If you're a limited company owner, you still could make those personal contributions, but quite often as a company, you might make an employer's contribution. So that's your company as your employer making a contribution on your behalf. So it doesn't touch your income, it's the company's contribution. We'll probably do another video on this expanding on that, but that could be quite a tax efficient way to get the money out of the company. And those contributions still count towards these other limits. So it's still worth considering around this time of year. So there we go, just put pensions in your head and think about that. There's a blog on our website where we talk about it in slightly more detail. Now, while we're on the subject of investments, I'm going to talk about limited companies a bit more in a minute as well. But if we're on the subject of investments, have a look if you're thinking of just doing the maximum to relieve tax. There are some normally deemed more high-risk investments. You should always get advice because they're normally for the more experienced investor. But there are things called VCTs, EIS, SEIS. These are these investment schemes that are out there, and it's where companies go and get a certain certification to qualify for a good tax relief for you as the investor, and that can be 30 to 50% tax relief that you get for buying these types of shares. And there's other long-term tax benefits. Again, it's probably a whole nother video, but if you are looking around for things to put your money into from a tax point of view, go and seek some financial advice and look into those things, because it's worth just mentioning that those are available and can relieve some tax as well. Now, the kind of mid-range things out the way, let's talk as well about limited companies. So if you're a limited company owner, you want to be having a look at what your personal money that's coming out is before the 5th of April. And this doesn't matter where you are, whether your financial year end for your company is October or November, it doesn't matter. You've still got to consider how much money you've had out in the tax year, because your company gets its bill and you've got your bill over here, and your bill is going to be based on what you've drawn in dividends and salary most normally. So it's the time to look at that. And if you haven't got an accountant looking at this for you regularly, you might want to do a quick bit of math yourselves and just make sure that you're happy that you've taken out what you could. And consider things like you're going to have cheap dividends up to around that 50,000 limit. So if you took your salary and then you stacked on the dividends you've already taken, if there's any gap up here between that and around this 50,000 mark, you might want to consider actually noting some more dividend. Doesn't necessarily have to be taken out of the bank, although that's nice, but you can put the paperwork in place to make sure that it's officially declared in that year and owed to you at a later date when you feel comfortable taking the cash in the business. But that can actually save some money, because you do lose that allowance, that basic rate band as it's known of around £50,000. If you stack the other stuff on top of it, that will just disappears each year. So quite often we say as accountants, we're talking to clients about actually paying a little bit more tax to make use of that. Because there's nothing worse than you thinking, oh, well, I'm just going to keep my drawings really low in 2-3 years, and then I'm going to take out 150 grand to put down on a house in this other year, and you end up paying massive dividend tax bills. So if we use the rates at the moment it's 8.75% in the dividends here in under 50,000-ish. If you go over that, you're looking at 33.75% and upward. If you're really successful, you take out a lot of money. So if you take out those big chunks later, you're going to pay an awful lot of tax where you could have noted some dividends this year and not paid that tax. It's a really, really big point. So go and have a look at that. Sounds odd, doesn't it, to say you might want to pay some more tax, but sometimes paying some more tax in the long-term planning picture is a good idea. So look at that one. And then when we're on the subject of extraction from the companies and dividends and salaries, make sure that you're happy with what you've declared on paper for your salary from the limited company. Now, we've got other videos talking about salary, but a lot of the time, the biggest opportunity we see is a newer business that hasn't actually declared any salary and didn't realize there was a benefit to doing so. But if it's, let's just say it's your only income, and you haven't actually processed a payroll salary, like you as an employee of your own company, for some amount, you're losing corporation tax. We quite frequently see about £1,700 opportunity just walking out the door through people missing this one. So again, there's other videos we've done on it, but just put director's salary in and you'll see why paying a salary might be a good idea. If you've got other income, sometimes it's not a good idea, but I want to put it on your radar. You can also squeeze some extra out. You might have only declared a small amount of salary, and it turns out that you could do a bit more for tax efficiency, or you've only declared yourself 5,000 where actually, and it's your only income, and say 6,500 might be better because it gets a tick in the state pension box. So it's almost an entire video that we could do talking about these different types of limits, but go seek advice if you can, or do a bit of Googling, watch some of our other content, and you'll hear me talking a bit more about the different levels that might be good for you during this year. I think there was a video we did do talking about the salary in this particular year. So look at that. It's a good time to react and just make sure that everything's as tax efficient as it could be. And then there's sort of 3 little points that I want to talk about that are minor things but are worth considering. One is child benefit. So if you earn over £50,000 in your household, you may, particularly if you earn over 60,000, a lot of people would have stopped claiming child benefit. In a recent video, I've explained a bit more about how this works and the fact that the government have now changed this limit. So you start losing your child benefit in this high income child benefit charge at 60,000 and completely lose it at 80. That means if you've stopped claiming it and you're in that kind of area, you might need to look at claiming it, or might want to look at claiming it in the new year. So I just want to put that one in your mind. If you have claimed child benefit in the last year and you're earning over more than 50,000, start writing down how much you received, because that will probably need to go into your tax return. And then if there is an amount to pay back, that gets bundled in with your tax bill to pay back. But bear in mind, it has changed. At the time I'm sending out this video, it might be in a case where you might be paying it all back this year and you might get it all next year. Just depends on where you are. So child benefit, have a look at that one. If you're married, there is something called a marriage allowance you can transfer from one to the other. I'd say for a lot of small business owners, it's rarely used, but there are opportunities for, say, sole traders where maybe you're earning, say, 40,000 and your other half's at home, has a part-time job and doesn't earn too much income. And you can transfer some of their personal allowance to you, the tax-free amount that you get every year, and that can save quite a few £100 of tax. So think about that. It's a bit odd because it's all or nothing, and there are some challenges with it, but that is worth exploring. If that scenario sounds like you, if one of you is pretty much at home not earning a lot and the other one is earning under about £50,000, the opportunity to use marriage allowance is there. Google it online, have a look and see if it suits your needs. And then finally, it's a bit of an odd one, but if you have got some cash to burn and you're looking to pass it to other generations for inheritance tax purposes, and it's not something we really talk too much about on this channel, you can give gifts away each year for about £3,000, and it doesn't count as your estate. So there's sort of a clawback rule. If you just give loads of stuff away and die in the not too distant future, that's still going to count towards your estate for inheritance tax purposes. But this gift allowance allows you to do £3,000 each tax year without any of that to worry about. So just think about that. If you're coming up to the tax year and you'd like to give some money to some people, make sure that's on your radar. And look, there's some tips for you. We've barely touched on the detail of those things, but we're late into the tax year and I'd like to just come on, just give you a few tips, a few things to look at. I think if you're a limited company, particularly, you're in control of a lot of those dividends and salary things. There's stuff you can do about it. If you're listening to this, you might be able to get your credit card and think about that expenditure to bring forward, those kind of things. You can still react. But some of these, you might think, I haven't got time to look at this now, but at least it's up here. You can think about it going into the new tax year, even if you missed the opportunity this time around. Hopefully this has saved you some tax. Please do share it with anybody you think needs to know this information, and I'll see you in the next one. As always, anything you want to talk about, drop it in the comments. See you soon.